Guys, Google and Microsoft just reported they crushed on revenue. They crushed on earnings per share. The stocks are actually surprisingly down after hours as of this very second. We're going to analyze why, and we have a third stock we're going to cover here in just a few minutes. So first off, let's pull up Microsoft. Microsoft and Google both hit 52-week highs today. Okay, Microsoft is currently down 660 after hours. Now remember, it is currently 8 minutes after they reported. When this video comes out, they would have had an earnings call and some other information. The things we're going to go through in this video are not time sensitive, so make sure you watch it to understand more about Microsoft. They were expected to report $2.77 in earnings per share. They reported $2.93 and revenue of 61.14 with actual reporting of $62 billion. They beat on both revenue and earnings per share, and for some reason, the market's punishing them. And it was immediate. So it's not like something else came out. We're going to get more information from them as time goes on. But remember, quarterly earnings results are nothing for us to get excited about, except when the stock goes down. We want to use bad information to help a stock price go down on a fundamentally strong business. You look at a company like Microsoft. Look at this balance sheet. Market cap, 3.05 trillion. Enterprise value of 3.13. This difference here is debt. Now, since it's $1 trillion, it's still about $80 billion in debt. But their cash flow is insane. In the last 12 months alone, they've done $63 billion in cash flow. So they can pay off their debt very easily. And that's the kind of company that can last the test of time. Look at this. Almost a 70% gross margin. That means for every extra dollar they sell, 69 cents goes to the bottom line before taxes. 69 cents of that before interest, taxes, and look at their 5-year and overhead, And their bottom line margin after taxes is 35%. That means every dollar they sell, after everything is paid, interest, operating costs, taxes, blah, 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 they're still left with 35% of that money left over. That is incredible, okay? Now, this company also has a great return on invested capital, if you see right here, 25% over the last 5 years, 23.6% in the last year. This shows a moat, and this shows they get a high return on the money that they invest in the business. Now, is this sustainable forever? I don't know. Probably going to be hard for Microsoft to move that needle, but if they're smart with their cash, they can do good things, buy back shares, pay down debt, make acquisitions, and they're smart about it. They can add a lot of value to that bottom line, but that's the hard part, being smart about the cash. Now, guys, Google was expected to do $1.59 per share in profit. They did $1.64 and $85.27 billion in revenue. They actually reported 86.3, again crushing. But let's look at the company. And by the way, Microsoft's now almost even. Let's look at Google, down 4.4%, over $6. Google is a favorite of our channel. And you'll see why shortly when I go through Stock Analyzer on these companies. You're going to see that Google actually isn't that overpriced at these levels. Now, I don't mean that in the sense of you should go out and buy. I just mean if you're willing to accept a more reasonable return than the exciting Magnificent 7 returns you've gotten, then Google might be the company for you. Again, just like Microsoft, great balance sheet, $1.94 trillion market cap, $1.95 trillion enterprise value. That's $10 billion of debt versus the $80 billion. And look at this. Their free cash flow in the last 12 months, $77.6 billion. It's actually higher than Microsoft's. And look at that. Microsoft's market cap is $3.1 trillion. Google is 1.94, even though Google has earned more free cash flow than Microsoft by 20%. Isn't that incredible to think about? And I personally believe that Google has more growth potential than Microsoft does. But Microsoft's gross margin's higher than Google's, and their bottom line margins at Microsoft is higher than Google's. Google's gross margin is 56%, Microsoft's 22 to 23%. So there's pluses and minuses here. But isn't it amazing? Free cash flow in the last year from Google is 20% higher than Microsoft's. That's pretty impressive. Guys, in the middle of making this video, we're actually going to add 2 companies to this. The next one is Starbucks. Starbucks was expecting to report 93 cents per share. They reported 90 cents, so they missed on EPS. Revenue expected at $9.59 billion. They reported $9.4 billion. Missed on revenue. So we had Microsoft and Google beating on revenue and EPS, beating on both stocks down. Look at Starbucks. They missed on both. Stock's up 3% after hours. This is the world of the stock market. This is what happens in the short run. We have no clue. If you had told me these numbers ahead of time, I'd have said, oh my gosh, buy Google, it's going to skyrocket. Buy Microsoft, it's going to skyrocket, and short the hell out of Starbucks. Literally everything happened flipped. Let's see how Microsoft's doing right now. Oh, Microsoft's now up 0.5%. Look at that, 0.8%. Guys, it's crazy out there. Now, they're going to have their calls. And if this is the kind of thing you want to look at, you can go back now and go listen to their calls or read the transcript of their calls. But these fluctuations are exactly why we want you to ignore that noise. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. I always show this. This is a stock's value over time, right? How did I get crooked there? Let's assume it goes like that. This is what the price does. This is just Mr. Market. From excitement to depression. Every day, Mr. Market's telling you, I'll pay you this, I'll pay you this. And then every day you're a buyer, a seller, or you can be neither. These are all the things you can do. You have to take that noise out, and it's hard. It's so hard at times. But that's why we have this channel. Because we believe when things seem the best, like they are now, that's the time to be most cautious. And when things will seem the worst in the future, that's when we'll be saying, don't worry, things will get better. These fluctuations have happened since the beginning of time on every investment. It's all based on people's emotions. 12 years ago, Microsoft was considered dead. The stock was in the teens. It is now at $400 a share, 35 times more than it was 12 years ago. And then guess what? The revenue's not 35 times higher, and the profit's not 35 times higher. It's just the market's perception of Microsoft has shifted. It was still a growing business with growing revenue, profit, and cash flow. And yet the market didn't like it. At that time, this is what they felt about Microsoft. Now, it's probably closer to here. Is that for sure? I don't know. Let's go check out the 8 pillars on these companies to see what they're like. First with Microsoft. Microsoft's back in the negative. Here's their 8 pillars. Guys, we love our 8 pillars. Remember, we don't make decisions based on these 8 pillars. We use them as a guide. 50 times earnings on Microsoft, 55 times price to free cash flow. The question I ask is that a reasonable price? Well, maybe. What has to happen in the future to pay more for something? Well, you think the revenue and profit are going to be much higher in the future than anticipated. That's the question to ask yourself. It might work. It might not work. We will go into Stock Analyzer tool shortly to cover that. Let's look at Google's 8 pillars. Same kind of idea, but lower. 35 times earnings the last 5 years, 36 times the free cash for the last 5 years. But if they're able to grow that profit and free cash flow with Microsoft at high rate, let's say, for example, there are 2 companies. One's going to grow at 20% a year, one's going to grow at 5%. Everything else is the same. You should absolutely pay more money for the 20% growth company versus the 5%. They're going to grow that revenue and profit at much higher clips. You should absolutely pay more. The question is, when these nosebleed prices come, is that a reasonable price to pay? I don't know. Let's go see what Starbucks 8 pillars look like. All right, Starbucks has a little more debt here. This is our long-term liabilities to free cash flow debt. About 10 times free cash flow multiple. About 10 times. It's a lot, but Starbucks has a lot of these leases. They have store locations. They have a brand. This does not worry me at all. I'm actually okay calling this essentially a check mark. Look what I did there. Isn't that pretty? I'm not worried about this. This debt level, it's a lot. We can go look at the 10K and see how much of it is long-term leases. They've got 1 billion locations in this world. That costs a lot of money. But the same multiple as Google. I don't know. Seems kind of hard maybe. Maybe it's not. Very high return on invested capital. Let's be more positive here. We're going to use green. The return on invested capital is much higher than even Microsoft or Google. And I think that's pretty indicative. If I told you name me a coffee company, everybody except for people in Boston are going to say Starbucks. And people in Boston are going to say Dunkin' Donuts. That's not a Boston accent, is it? That was a terrible accent. I apologize to everybody in Boston. All right, so that's where we stand right here before we go to Stock Analyzer tool. But there's one more company I want to show you. An AI player. In fact, some analysts have been thinking this is a better play than NVIDIA. I'm not going to get into that. AMD, they were expected to report 77 cents per share, and they reported exactly 77 cents per share. And they were expected to report $6.12 billion in revenue. They reported 6.2, and the stock is currently down after hours. Okay, not by much, but it's down. Oh my gosh, it was down a lot today. Down big time today. Look at that. So AMD is this big player. This is a company that was single-digit stock just 15, 20 years ago. It was clipping at Intel's heels. A lot of people think it's surpassed. Revenue-wise, it is not surpassed yet, but it's well on its way to doing great. They make great chips. Cannot complain about this company, and a lot of people think AMD is the better play than NVIDIA. But again, let's go look at the 8 pillars of AMD. A lot more issues here. Look at the shares outstanding. Guys, AMD has killed its past investors with this. They've increased their shares outstanding by 47%. 47%. That means if there were 10 shares outstanding 5 years ago, there are now 14.7 shares. If you owned one share 5 years ago, you own 10% of the business. Now you still own one share, but out of 14.73 shares, that's like 6% of the business. You got diluted big time. Is that what you want from your company? I don't think so. Look at this 5-year PE, 185. 5-year price to free cash flow, 168. Now, this is a company. Look at this. The last 12 months free cash flow is 1.3 billion. The last 5-year average is 1.7. I would have thought the 1-year free cash flow was like 4 billion and this was 1.5. This is, to me, crazy. Net income in the last year, 200 million. Last 5 years, 1.5 billion. Guys, I've said it before, and I sound like a broken record. It just seems so freaking expensive. Hey guys, I'm going to quickly go over our stock analyzer tool on all 4 companies. Now keep in mind, if you want a more thorough stock analyzer tool on these companies and ones I want to own, watch our next video on the 30 stocks I want to own and the prices I want to own them at. So Microsoft to start, 10-year analysis. I did all of my assumptions right here, which you can pause right now and check them out. And I only did a 9% return. So this does not include any sort of margin of safety. If I wanted to buy the company for what I think it's worth, stock's currently overpriced. The only one green on my highest assumptions. The rest of it is looking like bad returns here. So I'm just waiting for Microsoft to hit my price. Let's go to Google now. Same thing, 9% assumption returns. Look at this, guys. A low price of 109, high price of 250, middle price of 166. The question you have to ask yourself is the 10% return enough at current prices for Google for you for the next 10 years? If it is, I would take a deeper look at it. Third company, good old SBUX. My assumptions right here, 66 on the low side, 138, 96 in the middle. Again, no margin of safety. That's why I have my watch list at $80 per share. And the final company, AMD. Guys, this one's a tough one. $25 on the low side, 150 on the high, 70 in the middle. I have my watch list at 50. I'm waiting it out. Thank you for your time.